This is Wallet Brief, where we break down what actually moved the U.S. economy this week without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week and what it means for your wallet. Over the past year, the U.S. labor market has shown surprising resilience, even as other parts of the economy faced uncertainty. Hiring activity remained relatively steady, and unemployment levels stayed historically low compared to previous economic cycles. In the months leading up to this week, economists observed a gradual shift in hiring patterns. While job creation continued across many industries, the pace of new hiring began slowing slightly compared with the rapid expansion seen earlier. At the same time, some sectors such as technology and finance saw more cautious workforce planning. This shift suggested that the labor market was moving toward a more balanced phase after a period of extremely strong demand for workers. This week brought additional signals about how that adjustment is unfolding. New employment data and labor market indicators showed that hiring activity remains active in many areas of the economy, particularly in service industries, healthcare, and certain parts of the retail sector. However, employers across several industries are becoming more selective with hiring decisions. Businesses are increasingly focused on productivity and cost management while still maintaining enough staffing to support steady consumer demand. Looking at the broader trend, the labor market appears to be stabilizing rather than weakening. Job growth is still present, but it is occurring at a more moderate and sustainable pace compared with earlier periods of rapid expansion. For households, the strength of the job market plays a major role in financial stability. When employment remains steady, workers typically experience greater confidence in income security and are better able to plan for expenses, savings, and long-term financial goals. Stable employment conditions also influence consumer spending, which is one of the primary drivers of economic activity in the United States. When people feel secure in their jobs, they tend to maintain spending on housing, transportation, and everyday purchases. At the same time, a slower pace of hiring can sometimes mean increased competition for new positions, particularly in sectors that are adjusting to changing economic conditions. Looking ahead to next week, analysts will continue watching several labor market indicators, including jobless claims, hiring surveys, and employer sentiment reports. These signals help economists determine whether the labor market is maintaining its current stability or beginning to shift in a new direction. For now, the overall message from the labor market remains relatively steady. Job opportunities continue to exist across the economy, but hiring conditions are gradually returning to a more balanced pace. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.